Did you know that your fixed deposits, which you thought were the safest investment, may actually be making you lose money? Research says that after factoring in inflation and taxes, most fixed deposits, investors earn less than 4% in real terms. In my 37 years of experience, I have seen families proudly show me their crores in fixed deposits, yet quietly watch their wealth shrink. Today, I'm going to reveal 14 powerful insights showing you why fixed deposits are outdated. Now, mutual funds, arbitrage, equity savings, and gold can maximize your returns without unnecessary risk. Stay till the end because I'll also reveal how India's growth story can shape your family's financial future. Just last year, a client had 3 crores in fixed deposits and he thought he was having good money, but he was losing 10 lakhs a year when we reallocated mutual funds. But today, he's thanking me for protecting his wealth. Friends, if you want your money to truly work for you, watch till the end and then take action today. So 14 points, stay till the end. Number 1 point is that fixed deposits, how much are you getting? As a common layman, you may be getting 3%, 4%, 5%. As some special schemes, you may be getting 5 or 6%. Senior citizens today could be getting 6, 7, maybe stretched up to 8% in some banks. I'm talking of private banks, public sector banks, and the normal banks. I'm not talking about other corporate FDs, which are even more riskier than you thought because you don't know whether you get your money back or not. So why shift from fixed deposits? Reason number 1 is the tax which comes in annually. And number 2, there is no compounding effect happening on your fixed deposits. Year to year, 2 year, 3 year, 4 year, you renew. But there's no compounding on the interest which is earned. So there's no interest on interest. That's called as compounding. And every year, year to year, TDS tax will be deducted. Whether you are in 10, 20, 30%, depending on your tax bracket, the tax is going to be optimally cut. So effectively, how much are you getting? If it's 6% effectively, and the number 3 factor, 6% inflation eats away your money. So these 3 factors, keeping in mind, maybe giving you a fixed deposit post-tax return of just 4%. Maybe max 5%. So the entire money, if you're keeping concentrated in one bank or fixed deposits, this is the time really to think. Watch till the end because I'm giving you some tips. So that's point number 1 from my side. Fixed deposits look safe. But in reality, you know the reality. More than 5 lakhs, the government doesn't give any security to you. They're like food in the refrigerator. It looks nice, intact, but slowly it's losing its flavor. If you were in the 70s, 80s, maybe the 90s, fixed deposits were getting you 12% and inflation was also low and you were not so much into the interest tax bracket. So there it could be safe. But then you had the dial phones. That's for the 70s and the 80s and the 90s. So aren't you changing over the last 5 decades? Things are changing. So don't look at fixed deposits the way you looked at them or your parents looked at them 40, 30, 20 years back because they're slowly losing their flavor. Why would you let your 3 crore rupees a client had sit idle in a fixed deposit when smarter, safer options exist today? So that's my focus point number 1. My point number 2 is, why do these 3 category of funds which I'm talking, so I'm not saying just start investing. You need a personal financial planner, certified financial planner telling you all this. And then you need to also see your risk appetite, your time horizon, and your goal. Keeping all that in mind, I advise my clients 3 category of funds to start investing in a ratio I will tell you. Arbitrage funds, low risk. Equity, taxation, and the liquidity. You get arbitrage funds. So that's number 1. Number 2 is equity savings funds. So a balanced mix between equity and debt, stable growth. And the third is gold funds. Now, gold fund means gold mutual funds. So you don't need to buy gold physically or ETFs, just online buying gold mutual funds. Why? Because they're a very good hedge against inflation and globally a safe haven. A reference. A client once told me, I want fixed deposit like safety. He had come from Punjab to me and he had a session with me a few years back. So he said, I'm retired now and I like fixed deposits and I like fixed deposit like safety, but give me better returns. I said, there's nothing like fixed deposit like safety and like returns. So once he understood, had a session with me, got convinced, did risk profile, goal setting, where we created a mix of arbitrage, equity savings. So very low risk, good liquidity, and something he could manage. He could see it transparently. He could see it grow also. And he knew that today he can enjoy the safety, the tax efficiency, and the peace of mind. So that's my point number 2 for efficiency and that peace of mind which this client got. Now, these 3 category of funds which I have told you, they aren't random picks. They are hand-picked shields for your wealth. And that's what I do for my clients. So comment in the section below comment below if you would like me to personally share some of my more ideas. Now, the next point is a 40-40-20 allocation strategy for your portfolio. Now, this arbitrage, equity savings, and gold. With my clients, I normally do a 40 arbitrage, 40 equity savings, and 10 or 20% debt could be gold. So that's an inflation hedge also and protects against the volatility of the market. So giving that kind of a 50, 40, 10 or 55, 45 kind of an allocation is what I do for my clients once I understand the 3 factors: their goals, risk appetite, time horizon, and they understand, first of all, how equity, how mutual funds behave, how debt mutual funds behave. Point number 3, why not have pure equity? So you could ask me, Taresh, why simply not go to pure equity? We'll have equity taxation and good returns. But when your horizon is short, less than 3 years, less than 2 years, or let's say 6 months, and you love the fixed deposit. So I'm coming from that background, and I'm trying to upgrade you to a platform where you don't need to go to equity for long-term goals, taking high risk and are not understanding how equity markets behave, and you do not have a time horizon of at least 5 to 7 to 10 years. And in that scenario, when you're looking at and you're trying to look at 1 to 3 year horizon only, you have a goal that you need the money in next 6 months to 3 years. And you're not sure. In that perspective alone, it's safer to use this kind of an allocation and safer to use hybrid category of equity mutual funds because they also give you the tax benefit. Now, pure equity in the short term is like flying through turbulence. You may reach, but shaken. What do you need to do? So for gifting purposes, like you want to gift somebody in the next 3 months, 6 months, 1 year, up to 3 years, don't chase thrill and choose equity. Choose stability with purpose. Simple, keep it very simple and clear, and be sure that you understand the risk involved. Point number 4, the diversification benefit. Now, why did I give this 40, 30, 20? Why did I give you arbitrage, equity, and savings and gold? Equity is one of the main reasons that overall I look at stability, I look at growth. So arbitrage will give me that stability. The funds do not move much. So you can expect something like 6.5, 7. Don't quote me. I'm not giving you returns. I'm just saying they have given in the past. So they give you that kind of stability. They will not take you to 12, 15, 18, and they will not go like 2, 3%. So a short period stability is what arbitrage funds, mutual funds offer. Number 2 is equity savings. So offering growth, 7, 8% is what I've seen they have delivered. And finally, gold, a hedge against inflation. Equity markets go up, gold goes down. Equity markets go down, gold goes up. Last 3 years, gold has given fantastic so-called returns. Now, it depends when you're entering, and when you're exiting, but a kind of a diversified portfolio, arbitrage, equity and gold, equity savings and gold could give you that stability, growth and hedge. I often compare this to a cricket match. You don't win only with batsmen. You need bowlers, you need all-rounders, you need a captain. Diversification, therefore, is your winning team. So don't put all your eggs in one basket. One fixed deposit could be okay for like, your monthly household expenses, 50,000 into 10 months, 12 months. So keep 6 lakh, 5 lakh in one bank safe. Government also guarantees. And you will sleep better at night. So my action today is diversify today and you will thank yourself tomorrow. I will say that again. Diversify today and you will thank yourself tomorrow. Point number 5, India's growth story. Now, as today I see August, September, October, last 6 months, April to September, India is shining. Growth, GDP is like 6% plus. As of today, 7.6 recommended for this quarter, July, August, September. And we're looking at International World Bank and all these so-called international bodies saying India is growing at 7% plus with rising housing demand, reforms, foreign inflows, GST being cut recently. You can look forward to a GDP of 7% plus. Now, when I started in the 1980s, the per capita income was like, in dollar terms, $300. Today, it's $2,500 in dollar terms. Now, India's golden run has been running. Participate. India is not just growing, it's shining. And your investments must shine with it today, tomorrow, next 5 to 10 to 20 years. So invest where the future is, India, and invest in India's growth. Point number 6, do a comparison, do a comparative analysis, fixed deposits versus mutual funds. Fixed deposits, tax at slab, number 1, locked. Number 3, loss to inflation. So these 3 factors, in my opinion, with my experience with my clients, keep clients away from fixed deposits if they've taken my recommendation and they have consulted me. On the other hand, so fixed deposits, 3 minus points. Mutual funds, 3 plus point. Tax efficient, I explained the equity taxation part. Liquidity, 2 days time you can liquidate after the first 30 days and the 60 days and whatever it is the lock-in specific mutual fund. Number 2 is liquidity and number 3 is diversified. So a mutual fund, whether it's arbitrage, whether it's equity savings, is already diversified across 10 or 20 fixed deposits or government schemes or bonds. So it's already a diversified portfolio. And the third is they are inflation protected. So inflation is going to be like 4% in India going forward. So you are going to be inflation protected. That's my third point on mutual funds as a comparison. Finally, I would say in this point, the fixed deposits are like a parked car, safe, you feel. And but it's going nowhere. While mutual funds are like, well-driven, well-maintained car, safe and moving forward. So don't just park your wealth, drive it forward with smarter funds, with smarter advice, with India growing as such. So I would now give you point number 7. What could be the ideal asset allocation? In my opinion, when I did allocation for a client who had 3 crores to be parked for a period anywhere between 6 months minimum and 3 years maximum. So I said 40% arbitrage, so 1.2 CR, 40% equity savings, 1.2 CR, 20% in gold mutual funds, about 60 lakh rupees. So this 40-40-20 strategy is like a 3-course meal. Balanced, satisfying, nourishing. So look forward to this kind of a personalized allocation. You can also book a call. The description is given below. Comment and get connected with me. Point number 8 is alignment with your profile. Now, at this particular client, age 62, with no liabilities and all other goals settled down, this 3 CR was meant primarily for an eventuality that he might have to buy a house for his children. He is not sure. The minimum horizon is 6 months. So there is a need for safety and there is moderate growth. He's looking at something little better than fixed deposits. So this 62, 63 year, now it's been a year, wanted to gift a home for his children, buy a house. Now with this planning in mind, specific goal, specific time horizon and his risk capacity and all the goals also taken care. With this mix, money stayed safe, grew modestly, and was ready when he needed it most. So this particular strategy respects your age, your goals, and your peace of mind. Three things happen. So align your money with your life goals, not what people are telling you. Align your money with your life stage. Don't let banks decide your destiny. Point number nine, ease of operation. So one point contact, like I do for my clients, one point they know me. That this is, and they get an app to see, they get transparently able to see how their mutual funds are invested. There is a single point contact. They know app is there. You can go online. They can check CAMS Carvey report. They can go MF Central. They can check their portfolio. It's absolutely 100% transparent. So SEBI and Securities Exchange Board of India, AMFI, so that's a mutual fund association, are regulating these funds, and of course me also. So this brings transparent reporting to the nth level, and they can trust me. So with me, you don't get a salesman, you get a coach, as I'm trying to explain in very simple terms. So subscribe to my YouTube channel, stay connected. I simplify finance for you every week, giving you new ideas. Point number 10, what's my role? Why am I giving you this? So my role is a financial guide with a CFP certified financial planner, a trusted advisor, 37 years of experience, a good coach, guide, mentor, execution partner. So your money needs more than just a manager. I think it needs a mentor who can tell you, who can reply to your queries, whom you can trust and say, "Hi friend, I trust you." Because in money, you need trust more than just small returns here and there. So let me mentor your money. Reach out to me using the link given in the description below. Point number 11, key takeaways now. So again, I will repeat. Arbitrage is safety. Equity savings funds are growth. Gold is hedge. And tax efficiency and liquidity form 5 good factors why mutual fund combinations I've given you are much better than fixed deposits. So smart money isn't just about chasing return, it's about balancing safety, growth, and peace of mind. So take one step today, move from fixed deposits to smarter funds, and have that peace of mind that my money is growing better than beating inflation, better than what people are telling me, and being away from scams that, okay, invest here and invest. Point number 12, fixed deposits versus mutual funds. Some quick recap. Fixed deposits are taxed. Number 1, they are outdated. Mutual funds are liquid, tax smart, inflation proof. In 2025, fixed deposits are like, old XYZ phones, which are small hand phones, no WhatsApp, no camera, no 20 things in that. Reliable ones, but outdated now, not naming the brands. So upgrade your investments because your money deserves 2025-27, not 1995 one kind of a mix or 1970 kind of a mix. Point number 13. So now you know fixed deposits keep you static. So fixed deposits keep you static where you are in 1970, 80 or 90, while mutual funds move you forward. With this kind of right allocation, 40-40-20 allocation, you can maximize returns while you protect your wealth and have peace of mind that you're doing the best possible with best possible ideas and trust. So your money deserves to grow, not just sit idle like that. So like, subscribe and share this YouTube video with anyone who's still stuck with fixed deposits. My final call to you is, I'm Taresh, Bhatia, a CFP certified financial planner, founder, the Richness Academy. Don't wait. Don't let your money sit idle. Your money deserves clarity today. That's Taresh Bhatia, your certified financial planner, wishing you all the best with your money, with your happiness, with your joy and success forever.